Hey everybody, welcome back to lesson 4 of the Strat course. This lesson is going to be on stop losses. So with the Strat and with our actionable signals and full time frame continuity, the goal of our entries is to put us in winning positions. We want to know when the trade is going for us or against us right away, so we tend to keep pretty tight stops. Also, another differentiating factor of stop losses in the strat versus stop losses in regular technical analysis is stop losses in the strat are not used as worst case scenario. They are used to protect profit and to get us out of positions right away that are not going in our favor. So, there are two different ways that you can place stops for the most part. And we're not getting into multiple time frame analysis just yet. We are just teaching everything on one time frame, being very simple and straightforward. So, what we have here is a chart of the E-mini futures, and I'm sometime back, but you can see that we have a nice daily uptrend right here. So what this means is that you have full time frame continuity on higher time frames if the daily is in a nice uptrend. So what we're going to focus on is this 2 down and then 2 up reversal. So if you look at your strat combo sheet, the entry is a break above the 2 down when this candle opens. The target is the previous candle's high. So we have our trigger, which is at 41.55. So knowing that we have this nice uptrend, you can use a trend-based stop, which is a looser stop than the one I'm going to talk about next. But if you expect this uptrend to stay intact and you want to give your trade more wiggle room, you would put a stop at the low of your trigger candle. So this is your trigger candle, this is your entry candle. So you would put a stop here. Now, if you go and get your risk reward tool from TradingView, you're going to notice that this is less than a 1-to-1 risk reward. It's 0.8 to 1. So risk reward wise, this is not great. So the other place that you can place your stops is the 50% rule about outside bars. And we know how outside bars form is one side of the candle gets taken out, it can't hold it, and then it retraces 50% of the previous candle. And then we're going to target the other side of the candle. So we can also use the 50% rule as a stop because we want this to trigger immediately and we want it to hit our target. We don't want it to trigger and then begin to fail. That's not what we want when we expect to get in winning positions immediately. We learned about the 50% rule in the last video, in the actionable signals video. So you get your fib tool, you have the 0, the 1, and the 0.5 marked. So we know that the 50% mark of this candle, the closed candle, because we're pretending this is a live candle, is 41.34. We will move our candle to slightly under what half of the 50% rule is. So now when we get our long tool, we now have better than 1-to-1 risk reward. We have like 1.6 to 1. Okay. And if we go and look at this on a smaller time frame, because you might say this could have triggered and then it could have come back in. So let's go look at it on a smaller time frame, like the hourly, and let's see if it came back in on us. Okay, so here's the hourly time frame. Our trigger is right here. And the 50% stop was right here. And as you can see, in one hourly candle, we tripped our trigger and we hit our target. And this never came back in on us. So this is a really good example of a trade working and working right away in your favor. This is what you want to see. What you wouldn't have wanted to see was it trigger and then fall back in. Because if it had, that would be a failure of the trigger and you want to get out. You want to protect your money. Let's look at another one. Right here, we have a daily rev strat. So a 1, a 2 down, followed by a 2 up. Target 1 was right there. Target 2 is always to make, or your main target is always to make a new pivot high to shake out people who were short against this pivot high. Okay, so let's grab our stop. Okay, so we can see just based on this candle, it opened here and they bought it from the open. It was just buying from the open. Okay, so you could have also used a 50% stop. So under 39.39. Okay, and let's measure the risk reward on this trade. Okay, so almost 2 to 1. So this is a great risk reward using the 50% rule. Because again, we want to get in positions that we believe are going to go right away. And if they aren't, we do not want to be in them because we expect our trades to work right away. Okay, so coming more recent in time, we have a clear downtrend. So looking at a downside strat setup, we have a 2, 1, 2 down. We know what our trigger is, a break below the inside day. Target 1, target 2. There's a third target down here. That's kind of pushing it for a 1-day candlestick. So trigger here. All right, so let's see what the risk reward is. Let's say we would expect to hit this target because we know that this can move this much in a day. That's not a whole lot for the futures to move. So that is slightly less than 1 to 1. Let's get our fib tool. Let's get a 0.5 level. So anything above 37.85. I got right about that area. Let's get our short tool again. Let's move our stop down to there, our profit down to there. So this is almost a 2 to 1. So the moral of the story is you want it to go right away. Period. And ideally, it's going to hit your targets. Now, once it starts going in your favor, that's when you want to move your stop to break even. Because once you've hit your first target, you can take partial profit there and then move your stop to break even. And there's no better feeling than being a trader in a risk-free position, and then hold on to it and see if it can take out your second target. And then if it can, I'd suggest you keep walking it down to lock in that profit if you left a runner. However, in the strat, it is pretty common practice to take full exits at your targets. And if it's going to keep on going, you can look for an actionable signal back in on a smaller time frame. But that is for a different lesson when we're going to talk about actionable signals and domino effect trades and using multiple time frames together to form the highest probability trade with the lowest risk. Now, if you're going to use a stop way up here, as opposed to the 50% rule, you're going to have to size smaller because you're risking more money. Okay, so I switched to SPY so we could do a little position size calculation. So let's say you have, these are just nice round numbers. Let's say you have a $50,000 account and you only want to risk $500, okay? So using the full stop, so the trend-based stop, if you will, you could buy 82 shares of SPY, okay? Let's say you're using a 50% stop, so anything under 375.70. Okay, so you could buy, or sorry, you could short 170 shares of SPY and only risk $500. So your position sizing based on which stop you're going to use will affect your position size. And this risk reward is much more favorable than the stop all the way up here. And then again, once it starts to move in your favor and it goes 212 down, stop goes to break even. We want to know we're right, and we want to know we're right away. And then we want to protect our money at all costs, because if we don't have any money and we aren't tight with our stops, then we can't play this beautiful game anymore. And again, why we use the 50% rule is because we know about outside bars. So if this candle opened, went 2 down, and then turned around, we're going to become an outside bar and we're going to go take out this high. So why sustain or take on all this risk when you know that the likelihood of becoming an outside bar are very great once we pass this 50% line? It's not smart. There's no reason for it. So that's why on the 2022 Strat combo sheet, we have updated the stops to a 50% rule. Okay, I hope this has helped you understand where to put stops and the fact that we move them and we try to be in break-even positions as often and as soon as we possibly can. And when trading the Strat, we expect our targets to get hit and not our stops. But in the event that we are wrong, or for some reason time frame continuity changes and the direction starts to change, we are out of there. We do not hold on to losers. All right, I will catch you guys in the next lesson.